Welcome to the Mortgage Update with Dan Frio. For over 10 years, Dan has been helping AM 1160 listeners. With so many companies to choose from and hundreds of loan options, the mortgage process can be confusing and costly. Be sure to listen each day for Dan and learn the difference between FHA, VA, and conventional loans. You'll also learn how to negotiate lower interest rates and fees, as well as steps to buying your first home and whether refinancing makes sense. Stay tuned to find out why Chicago's top realtors are choosing Dan Frio.
Welcome to the Mortgage Update with Dan Frio, and I, of course, am Dan Frio. Got a special guest here with me today, John Maxim from Illinois Housing Development Authority, also known as IHDA. So I only thought that IHDA had one, maybe two different options to choose from. As I'm finding out more and more and more, there's, I know, 4, if not more. So if you can kind of lay out all the options people have and what, why somebody would go with option A versus option B and so forth.
We develop programs to help different types of scenarios.
Okay.
With the access programs, the 3 programs I'm talking about, it's first-time or non-first-time home buyers, meaning if you own a house now, you can buy a new one and retain the current one. Of course, lending rules, FHA, you can't have 2 FHA loans, but you know those. Yeah. You'll discuss them with that. These 3 programs are available in any county in Illinois. And these 3 programs, the First Home Illinois, because the source of funding does not allow for new construction, but the access programs do. So say you're buying a new construction house, the final loan, you can use our assistance for a new construction house.
Sweet.
So the first option we have, it's called the forgivable program. It gives the borrower 4% of the purchase price with a max of $6,000. And what that means, if they're buying a $100,000 house, they would receive $4,000 in assistance. If they're buying a $150,000 house or above, they would receive $6,000 in assistance. The way that works, it's forgiven over 10 years. Okay? They have a second mortgage for, we'll use the $6,000 if they're buying a $150,000 house or above. They have a $6,000 second mortgage. Mm-hmm. Every single month, they're making a payment on their main mortgage, $50 would be forgiven. So if they stay in that house for 10 years, do not sell or refinance, that $6,000 is forgiven.
Okay.
If they do sell or refinance before that 10-year period, they will pay back that prorated portion which isn't forgiven. So to make numbers simple, say they stay there 5 years on the dot from that first payment, they pay back $3,000.
Gotcha.
That's the forgivable program. The deferred program, I like to think of it as a deferred loan, okay? We're going to give them 5% of the purchase price up to $7,500. So using that $100,000 example, $100,000 purchase price example, they will receive $5,000 assistance. If they're purchasing $150,000 or above, we're going to give them $7,500. Okay. This is a deferred loan. When I give trainings, I like to give an example. This is like borrowing money from a rich uncle or aunt or a family member. All right. There's no interest. None is forgiven. But when you sell or refinance or keep that mortgage, your first mortgage for 30 years, you will pay it back. So it's interest-free money. It just sits there. Think of it as a silent second. Yeah. So when you go to sell or refinance, you will have to pay it back.
Gotcha.
But it allows you to get in the house. All right. And then that's the IHDA Access Deferred. The third option we have is IHDA Access Repayable. And what that is, it gives you 10% of the purchase price up to $10,000. So if you're buying $100,000 or below, you take 10% of the purchase price. $100,000 or above, you would receive $10,000. That $10,000, it is repayable. Okay. You will pay it back over a 10-year period at 0% interest. And if you get the full $10,000 on a purchase price, $100,000 or dollars above, you're going to pay back at $83.33 per month. So if you went out to a borrower, Dan, and says, I can give you $10,000, 0% interest, would you use it to buy a house for $83 a month?
You betcha.
Absolutely. I mean, that's where our programs, come into play. With this program, if they're buying a low purchase price, maybe they have a little bit of money saved up. Yeah. Maybe this $10,000 puts them down to 20% down on a conventional loan and they avoid MI. So there's all kinds of situations.
Yeah.
All 3 can come into play.
Got it. Okay, so I'm going to be devil's advocate, kind of, sorta. If I'm I'm looking at these. Okay, I can get the repayable one at 0% interest, which is awesome for 10 years, but I need to make an $83 payment. Or I can get the one that's 0% interest, but I pay back. I no payments, but I pay it back eventually when I sell my house. Or I can get free money. And this is in my head, so just bear with me on this one. Why do a lot of people not choose, or maybe they do, the forgivable one? It's basically free money that's just, you don't pay it back ever, unless you sell the house prior to 10 years.
A couple reasons might be why. You might be planning to stay there a couple years.
Okay.
So not that much is forgiven. And then another important factor that comes in play is the amount of assistance, how much you need to get in the house.
Okay.
So say, like I said, you're buying a $100,000 house. Let's just use that scenario. On the forgivable, you get $4,000. On the repayable, you get $10,000. That $10,000 when you're purchasing can make a difference. So
huge difference. Yeah,
just depends.
To pay the juice of $83 a month, not bad.
Yes,
Got
exactly.
it. Okay.
And that's 0% interest. So you can't really find that anywhere to buy a house anyway. So.
Got it. So I was going to ask you some questions about like veterans and other things like that, but you can do a VA loan basically and get in that case, you could probably go with the forgivable at 4%, because even with a VA loan, you have, and most people don't understand this, it's 100% financing. However, you still have closing costs, and those closing costs are probably going to be about $5,000. Between the lender fees, the title fees, and everything else. So could you use the forgivable on a VA loan and get these, let's say it's a $150,000 loan, get the $6,000 to pay basically your closing costs?
Yes, you can do that.
Okay.
You can also use it. There's a VA funding fee. You're the lender.
Right, yeah.
But you can use it towards that instead of just financing it in the loan and everything. So yes, you could.
Gotcha. Okay. What other programs does IHDA offer other than, and there might be and there might not be, but we went over 4 phenomenal programs. But what else does IHDA do?
All right. Not to bore you, but we have an i-refi program. This is for underwater borrowers. It's not a main program it's used, but I'll go through it real quick. So just so you know about it, Dan, for customers, or you can help somebody. The i-refi program, it still has the restrictions of our income limits. They're around 100,000 depending on county. Still need a 640 credit score. You need to credit qualify for a refi, okay? It's for borrowers that are underwater on their mortgage. Underwater meaning, I'll give you a scenario. Say they owe $125,000. The order of appraisal comes in at $100,000. There's not many solutions right now. What the lenders that offer this, what they will do, they will give them a new loan based on that $100,000, anywhere between 90 and 97 LTV. So I'm going to use 95% LTV. LTV is based off the appraised value, but they're going to give them $95,000 loan.
Okay.
They owe $125,000. What IHDA is going to do is we're going to give them that $30,000 plus money towards closing costs.
Okay.
So let's use $5,000 like you used in another example. We're going to give them $35,000. You're going to give them the new loan. We're going to give them $35,000. That money's forgiven in 3 years. So if they stay in the house 3 years, they're going to have a mortgage for $95,000 at current interest rates. We're going to give them $35,000 forgiven in 3 years. So it's for people that have paid their mortgage on time and are underwater.
Wow. Phenomenal program. So I want to thank John for coming in today. Thank you so much. It was an eye-opener for me, and I've heard all about IHDA for years and years and years, but as an independent broker, I wasn't able to offer it. Now I'm happy that we at Parkside Lending are that we can offer this program to everybody out there in Illinois. So what we want to try to do is get the 1 out of 6 or 1 out of 10 people that's buying their first home and get them more familiarized with this program. I'm going to throw 10 questions at you. They're what I would consider the most frequently asked questions in regards to a down payment assistance program. So you ready?
I'm ready.
Don't strike out.
All right.
You're the household expert.
We haven't even gone over these, so
Gotcha.
I'm ready.
So yeah, we're just flying on this one. So the first thing is, and there's no specific order, but the number 10 is basically kind of, I think, one of the biggest questions there is. But the first one is, what is the minimum credit score needed to qualify for the IHDA program, or the minimum of any of the programs?
It'd be a 640, 640.
640, okay. So just if you're out there and you have 3 credit scores, there's TransUnion, Equifax, and Experian. If you don't have your credit score, don't know it, let me know. But most people do know it. So a 640 credit score is the minimum credit score allowed to get you into this program. Now, the next question I'm going to have, and you'll know what I'm talking about, but I'll explain it here in a second. What is the maximum debt ratio, or we call it in the business, debt to income ratio, to qualify? Here, let me explain what your debt ratio is for those that don't know. But it's pretty simple. Debt to income ratio is your debts, so everything on your credit report, plus your proposed mortgage, that's your debt, divided by your income, so debt to income. So if you have $10 in debt and you make $20, you're at a 50% debt ratio. Hope you get it from there. So what's the debt ratio qualifications for the IHDA programs?
At 45%. That's 45%.
Okay.
Yep.
Did it used to be 43 or no?
I've been there 6 years. It's always been 45. Okay. It might have been before
For some reason, I thought it was 43, but that 45 is awesome. And that's where a lot of conventional financing puts you. So that's a good trigger. So a 640 debt ratio. And if you need help calculating this, guys, if you have a 640 credit score, you're interested in doing this, just call me. I'll walk you through it. Okay, the next one. And a lot of people had problems, 10 years ago, when I always say the world ended. A lot of people went through foreclosures and short sales.
That's a great question.
How long do you have to be out of a foreclosure or short sale to qualify?
I could sort of put that question back on you. How long do they have to be out to qualify for FHA loan?
Got it. Okay, so basically you go off of the guidelines that we're qualifying you for.
Yes, that's correct.
So if it's a shorter time, we're going to look at going with an FHA program. If it's a longer time, we're going to look at going with a conventional program. So, that answers that question. This might be the same answer to this one. How long do you have to be out of a bankruptcy to qualify for the IHDA programs?
That would be the same answer. Whatever agency.
Okay. Yeah, so it goes off of the FHA and the conventional guidelines. Correct. And you can check out my other podcasts, YouTube channels, and other radio shows that I basically break down how long you have to be out of foreclosure, how long you have to be out of bankruptcy to qualify for different programs. Welcome back to the Mortgage Update with Dan Frio, and I, of course, am Dan Frio. Got a special guest here with me today, John Maxim from Illinois Housing Development Authority, also known as IHDA. Okay, 10 questions. They're what I would consider the most frequently asked questions in regards to a down payment assistance program. So the next one is, can you have a cumulative amount of collections? Let's say I have a medical bill for $1,000 and 2 cell phone bills for $300 a piece. So now I have $1,600 in collections. Do those need to be paid prior to me closing? Or can I keep them? Or what do I need to do with my collection accounts?
And that's what's nice about our program. That goes back to what FHA or conventional requires. So there's not, for our program, there's not many overlays. That 45 DTI 640 credit score, but that's about it.
Got it. And if anybody wants to know about overlays, glad you said that. I have a specific video on YouTube. Just go to YouTube and check out the Mortgage Update with Dan Frio, and there's a YouTube of what are overlays, because overlays can kill a lot of files. Or a lot of people looking to buy a home. So, you answered my question on collections. Same thing with judgments. It depends on the program that you're qualifying for.
Absolutely.
Okay, got it. All right. Can you have what we call a non-occupant co-borrower? So meaning you're trying to apply to buy a home. You fall short on, normally it's income, so because you cannot debt ratio that debt to income we talked about. So you might ask somebody like mom, dad, aunt, uncle, brother, sister, somebody like that to co-sign with you, but they're not going to live in the property. So it's a non-occupant borrower on the mortgage. Will IHDA allow that?
That's a great question. And no, you cannot with IHDA have a non-occupying co-borrower.
Got it.
Because we go off household income from all borrowers. So
got it. Okay. Got it. All right. So now the next question I have is, there's what we call LTV. It's your loan to value. So make it simple. You have a $100,000 loan. Your house is worth $100,000. You're at 100% loan to value. Make sense? You take the value divided by, or the loan amount divided by the value of the home. That creates what we call loan to value. Because you can do a VA loan, which is 100% financing. So a veteran, God bless them, they bought a $100,000 home. We gave them a $100,000 mortgage. But now they're getting an IHDA program. So they're going to get $6,500 through IHDA. So basically now the liens on that property total 106.5% because, again, they owe $100,000 plus they're getting $6,500 from IHDA. So they owe $106,500 on a home that's valued at $100,000. So we're over 100% of the home's value. Is there a cap on how much that can go to?
So conventional financing allows for 105% CLTV, combined loan to value.
Okay.
And then government financing, your VA, USDA, FHA, there's no max. When you run it through the automated system, depending on the credit, they might max it at something depending on the credit, but there's no set max with government.
So cool. So you could technically do the 100% financing, get $6,500 through the IHDA program through me, and you're at 106.5% combined loan to value, and that'll go awesome.
Yep.
Sweet. All right. Next question is, many times people are short funds to close. So, and I know IHDA has a program that you need at least X amount into the deal if and when you close on that home. Can that money be gifted from a family member or relative?
Yes, it can. So you have to follow guidelines from FHA and conventional, but yes, it can be gift funds.
Okay, and what's the skin in the game required by IHDA?
We require the max of $1,000 or 1% of the purchase price. So under $100,000 purchase price, they have to have $1,000 into the transaction. Over $100,000 purchase price, 1% of the purchase price.
Okay, so the $1,000, they have to go to closing with $1,000.
No, they do not.
Okay.
Typically, through a real estate transaction, you have something called earnest money. And I'm sure you've talked about that, Dan, before, where you put a deposit to hold the house with the realtor. Well, that counts towards it. And anything else, I think you used the term skin in the game or borrow investment. You pay for an appraisal, okay? That can count towards it. You prepay your insurance out of pocket. Oh. That can count towards it. You pay for an inspection.
Well, there's $1,000 there, easy.
Yes. So it's not like they have to come to closing with that money.
Got it.
They just have to have skin in the game towards.
Because many times people they pay for the appraisal. That's $400. They pay for an inspection. That's $300-$400. And then you have to get in your homeowner's insurance, and that's going to be $500-$800. I mean, you should easily hit the $1,000. Well, in your example. So I'm thinking they got to pay all that stuff, and then they still have to come to closing with $1,000, and that's not the case.
That's not the case. And earnest money is probably one of the biggest ones.
Got it.
Putting earnest money, you're
going to need $1,000, $1,500, $2,000 in almost every case.
Yes. So so most of the times you're going to be covered, for that minimum investment.
What property types will IHDA lend on?
Single family, condo, townhouse, and up to a 2-unit property.
Okay. And they need to be going to be your primary home. You cannot do a rental property, correct?
Correct. The only time you can have some rental income if you're buying a 2-unit, you can reside in one and rent out the second unit.
Got it. Now, the big question I have, do you have to be a first-time home buyer? So this is going to be your first home ever in your life?
Absolutely not. We have programs. We have 4 programs. 3 of the 4 programs, you do not have to be a first-time home buyer. Matter of fact, with those programs, if you own a house now and you're upgrading or you're going to buy a new house to live in, you could actually retain your current residence as an investment, a rental property, and use our programs to buy that new primary residence. Okay.
And then the other program you have, I think in one other segment you said it is a first-time home buyer program, but as long as you have not owned a home in the last 3 years.
That is correct.
3 years, correct? Okay.
Yes.
Got it.
And if you're a veteran, you're exempt from that first-time home buyer requirement.
Sweet.
Yeah,
so those are the top 10 frequently asked questions that people have that I get from people looking to buy a home that just don't have the money and they have questions in regards to what programs are out there that can help me with my down payment program. So, John, I want to thank you so much for coming in today. I mean, you were a huge help, not only to me, but all the listeners out there. So, recap again, who, what's your name? Who are you? What do you do? And if they need your services, how do they get a hold of, to get through the IHDA programs?
Sure. My name is John Maxim, like you mentioned. I've been with Illinois Housing Development Authority, IHDA, for 6 years. Our website is IHDAmortgage.org. You can contact us there. Also, our programs, one good question about down payment assistance. How do I get down payment assistance? Nothing is done through us, Dan. They will go to you, the lender. You guys actually front the money, so they don't have to apply through us. You will handle everything start to finish. Your closing time is not held up because you, the lender, are doing everything. So it's a nice, smooth transaction. It's not like you're dealing with a government entity to wait to approve something.
Awesome.
So it's great that you guys handle everything.
Got it. Awesome. And I want to thank John again for coming in today. John is with the Illinois Housing Development Authority. To get all these programs, to get into an IHDA program, or to see if you qualify for that program as well as the mortgage credit certificate, give me a call. When you call in, the one thing that I say on my commercials, and people still kind of get dumbfounded when I do answer the phone, is you'll talk with me and deal with me personally 99% of the time. If not, one of my assistants will take the phone call, usually take down some of your information, and I'll get back with you. Let's end today on a credit hack. I've said this one before, but I don't think a lot of people get it. And there's also, I get a lot of contradiction on when I ask people to do this. They're like, well, they're going to pull my credit and I'm going to get a hard hit on my credit. Yes, but let's look at the net benefit that you're going to get out of this. So I just recently closed on a client that was looking to buy, and I worked with them for about 4 or 5 months to get their credit scores up. Here's what happened is I pulled their credit. They've never missed a payment ever, and their credit was like 560. You can't get them qualified for a 560 loan with a 560 credit score. So I'm looking over their credit scores and their credit accounts, and I noticed a pattern. There's a Discover card, there's a MasterCard, there's a Visa, there's a Target, there's a Walmart. They have all these accounts, and they don't owe much on them. Each one had maybe $200 on there. So I'm thinking, what is it? Well, I look over to the high credit limits, and every one was like $100 or $200. So if you have a Walmart account that you owe $100, you're thinking, well, I only owe $100. I mostly pay it off every month. Well, what's your high credit limit? If it's $100, you're showing is maxed out. So it's like having a $10,000 high limit on your account and owing $10,000. And you're thinking, well, that's $10,000. Well, yeah, but it doesn't. The algorithms don't look at it that way. They look at it saying, here's your high credit limit, and here's what you currently owe. What percentage of that is it? So you take your what you owe divided by your high credit limit. We want you at 30% or below. So let's take, for example, this person. What I did is I had them call every one of those credit agencies and ask for an increase in their line. They called 3 of them. Then we stopped there, and here's why. Every one of those agencies or those companies increased the person's credit limits to $2,500. They owed $200. So now they went from maxed out. So what we call their utilization ratio was at 100%. Now their utilization ratio went down below 10%. We got them up to a 640 credit score, and they qualified for every program under the sun. So here's the question I always get. Well, Dan, when I do that, it's going to be a hard hit to my credit scores. Absolutely. Yes, it is. But you're getting hit for that credit pool. Let's say it hits you 5 points. But now your utilization rate went from 100% down to 9. You'll probably pick up 50, 60, 70 points. So we picked up, let's say 50. You picked up 50. You lost 5 for the credit pool. You're still net plus 45. Multiply that by 2 or 3 accounts. It might not be in that increments, but let's just say the credit pools cost you 50, but you picked up 150 by getting that utilization rate down. So you just picked up 100 points on your credit scores. That's my hack of the day. Thanks a lot for tuning in today. We'll be back same time, same place. God bless.
You've been listening to The Mortgage Update with Dan Frio. For over 10 years, Dan has been helping AM 1160 listeners. With so many companies to choose from and hundreds of loan options, the mortgage process can be confusing and costly. Be sure to listen each day for Dan and learn the difference between FHA, VA, and conventional loans. You'll also learn how to negotiate lower interest rates and fees, as well as steps to buying your first home and whether refinancing makes sense.